Everything about this stock market is healthy, except possibly one thing. I'm going to show you how all the signs point to a healthy stock market, but there is one thing that gave me some pause. What looks good so far? Well, if we look at the price movements over the last week, you can see here that ARK, the riskiest investment category, outpaced everything for the week, followed by the NASDAQ 100, a little bit less risky, followed by the S&P and small caps. Small caps, you could argue, should be higher, but this is okay. And Dow finished dead last. This means people are selling safe haven assets and putting them in risk assets. This is a really, really good look. If we look back over the past month, same story. ARK Invest leading the way out, followed by small caps, followed by the NASDAQ 100, followed by the S&P, followed by the Dow. This looks great. And if we look back over the past year, you can see the damage that's happened. ARK Invest is way down here, followed by the NASDAQ, followed by the S&P, followed by small caps, followed by the Dow. This, over the long term, is not what you want to see, and it's most likely not what's going to happen. So why do I say this? Well, let's take a look. If we look back over 5 years, so now we're getting a little bit longer view, right? You're supposed to be a long-term investor. So let's look at how these things have played out over a longer term. And you can see here, yes, ARK is underperforming all of these, but when things are good, ARK handily outperforms everything, as you can see back here. But excluding ARK, you can see the NASDAQ 100 finished in first place, S&P in second, Dow in third, small caps fourth, and then, as I mentioned, ARK is lagging right now. But this will change if the market continues to be healthy. ARK will shoot past all of these, and this current order will pretty much stay the same, except the NASDAQ will also take off. So what do the current dynamics tell us when we look at the bottom analysis? Well, you can see here that we had an attempt at a bottom confirmation. As I said in the last video, this is a nice to have. It's not a requirement. But right now I have to tell you, things look very healthy. Let's take a look at equity versus safety, because this really gives a good tell into the health of the markets, not just the equity markets, but the Treasury markets as well. So you can see back on December 30th, we had an unhealthy stock market with the stocks ranked down here, and a very unhealthy Treasury market with longer Treasuries ranked 9 and 10. This was an absolute disaster. Gold, cash, and T-bills ranked 1, 2, and 3. This is a very unhealthy risk appetite. By January 6th, you can see that stocks started moving up. IWM was in third place, and TLT and EDV, both long-term treasuries, were starting to move up. So the health of the equity markets and the health of the treasury markets was improving back then. Then last Friday, we had IWM in first, NASDAQ 100 in third, EDV in fourth. So now you have a healthy and improving stock and treasury market. And then what do we have this last Friday on January 20th? This is wonderful. The NASDAQ 100 in first, small caps second, S&P 500 here, and then Dow way down here. And now why is Dow ranked 10? You're saying, well, if Dow's in 10th, doesn't that say that there isn't a healthy risk appetite? No, actually the opposite. People are selling the safe Dow stocks to buy the riskier stocks that have pushed these up. This is exactly what you want to see coming out of a bottom. And what about the Treasury market? Well, we have long-term Treasuries, EDV and TLT, ranked 4 and 6 ahead of the shorter-term Treasuries and cash. This is absolutely what you want to see. This looks great. Let's take a look at the buying and selling pressure, because this is yet a different view into the markets. And no surprise here, right? You would expect the Dow to have the selling pressure above the buying pressure, which it is. It hasn't been performing well lately because these stocks are getting dumped in favor of riskier stocks. What about the S&P 500? Somewhat similar picture, but a little better. It's kind of hard to see here, but the buying pressure, the solid gray line, is just touching the selling pressure here. And you can see how the S&P moved up here. What about the NASDAQ 100? Totally different picture. You can see the buying pressure is still well above the selling pressure even though it's kind of backed off here, and the 1 month trend is increasing very nicely. And you can see the price increased very nicely, and in fact, it's above these previous levels. This looks great. What about Russell Small Caps? Now, you can see that the buying pressure really peaked out here and then collapsed and is coming back again. So we'll have to see how this one plays out. That doesn't look as good as the NASDAQ 100. And what about ARK? Just like the NASDAQ 100, the buying pressure is still well above the selling pressure. Very strong 1 month uptrend. This looks really good. So what could get in the way of all this wonderfulness? Well, we have a Fed meeting coming up on February 1st, and depending on what they do and what they say, it could cause problems in the equity markets. But we'll just have to see how this plays out. But I have to say, right now, things look very good. What about the sector rankings? Now, this is an area where initially it gave me some pause, but let's talk about it. So if we look at the sector rankings from last week, you can see cash was down here. This is great, right? Now, these are the top ranked sectors. And you've heard me say before, I'd like to see cash fall off of this table. Well, got my wish. It's no longer on this table. So cash has fallen off these top ranked sectors. And let's take a look into what's happening here and how things are moving around. This will give us a really good picture of the risk appetite last week versus this week. So last week, technology, semiconductors was ranked here. Well, where is it this week? You can see how it's handily moved up the rankings here. This is a good, healthy appetite for risk. What about the Dow? Remember, these are the safer stocks versus emerging markets, emerging companies, and emerging companies. So small caps, smaller NASDAQ companies, emerging markets. Let's see how this played out coming into this week. Well, you can see that the Dow dropped down because people are selling it. And you can see all of these emerging companies and emerging markets are moving up higher in their ranking. This is really good. Now let's look at the other end of the spectrum. So let's look at the worst ranked sectors. So last week, we had SPY here, we had technology here and here, the NASDAQ 100 was down here, and then we had Bitcoin and ARK way down here near the bottom. Well, let's see how they look this week. Well, you can see that ARK is still down here near the bottom. Now remember, these move slowly. This model looks over a longer time period, so it takes a bit longer for things to change. But you can see here that SPY has moved way up here. Technology, XLK, has moved up here. The Qs have actually moved up. You can see that here. They've moved from down here to up here. So that's good. And Bitcoin has moved up. This is all really good. Now let's focus in on the Treasury market and see how they look. So you can see here that the longer term Treasuries really shot up here. You can see that EDV and TLT moved up very nicely here, but then they collapsed toward the end of the week. So this is pointing to, right now, an unhealthy Treasury market with the longer term Treasuries here and here. We'll have to see if this continues or not. And how does that show up in the buying and selling pressure? So you can see that the selling pressure is moving up dramatically here, even as the price of intermediate Treasuries has been moving higher. This is not looking good. What about a little bit longer duration, 7 to 10 year Treasuries? So I call these intermediate to long Treasuries. So you can see here the buying pressure was really, really building here. And we have a very nice 1 month trend here. But the price has fallen recently, and you can see that the buying pressure is collapsing and the selling pressure is coming up. This does not look good. What about long-term Treasuries? Remember I said earlier in equity versus risk, they look fairly healthy. Well, you can see some of that here. The buying pressure is still above the selling pressure. We have a very strong 1 month trend upward, and the price has been moving higher except for the last couple of days. And what about gold? Gold has been defying gravity lately. It's been absolutely crazy. So you can see it's had a very nice rally here, and you can see that the buying pressure was well above the selling pressure until about a week ago when it absolutely started collapsing. Now you can see it's still above the selling pressure, and the 1 month trend is still very nicely up, but we'll see where this goes from here. Gold's a tough one. It's not really correlated to anything. And then finally, Bitcoin. This is the riskiest asset class that we're going to look at here. And you can see it's had a very, very nice run higher. The selling pressure has stayed down low. The buying pressure really shot up here, and then it collapsed and is heading lower. So we'll have to see how this plays out. But right now, this looks really good. So why was I concerned about what I was seeing? Well, Over the last several weeks, I've watched the materials sector ETF, XLB, move up in the rankings very rapidly. I said, oh my God, if those are materials, that means they are commodities, and that means inflation could become an issue. All right, so if we look at the holdings of XLB, XLB's holding a company called Lind PLC, 18% of its holdings. That's a very large holding. Followed by Air Products and Chemicals, 7.75% of its holdings. Followed by Sherwin-Williams, 6.35% of its holdings. I would argue none of these really is a direct reflection of commodity prices, and I'll show you why in just a minute. And then it's followed by Freeport-McMoRan, which we all know deals in commodities very strongly. And then there's some other ones, Newmont Corp in here, and there's some of these are more materials-oriented or commodity-oriented than others. But Lind and Air Products and Sherwin-Williams are not. So these are dominating this ETF. Lind produces industrial gases. That's not really a commodity. Air Products, as the name implies, produces industrial gases. And Sherwin-Williams, as we all know, produces paint. This really has little to do with commodity prices. And if we look, let's take a look at the Dow Jones Commodity Index. You can see that it peaked out way back here last February to April, and it has fallen dramatically and has not recovered. So I'm not really concerned about materials costs and commodity prices going up as a result of XLB moving up in the rankings. Given the current healthier appetite for riskier assets, this market looks fabulous right now. I'm Calvin Rose, and thank you for watching Invest Smarter today. That's all for now.